So good morning. My name is Michael George. I'm one of the financial remedy specialists here at 3PB. For those who don't know us, we're a set of chambers of about 270 barristers. That's including 50 staff, and there's about 70 odd in our financial remedy team. Now, as you're aware, this is one of our breakfast brunch seminars, and I'm joined today by Andrew Donaldson from Dains Accountants. Andrew's one of the founding members of the team. I've worked with Andrew on a number of cases, both as an SJE and also as a shadow expert. He's pretty good at both, quite frankly. And also Andrew's team also have access to a team of tax accountants of about 20 odd. And that can be very important when you're looking to unpick cases, unwind companies, and those sorts of things. Andrew also has the advantage of a track record as a financial director of 10 years experience. So he has real life experience of real life companies. And personally, I found that very useful indeed. So let us start with our topic. So if I can get the screen share working properly. We have our topic here. Valuing the valuation, getting the most out of your expert in uncertain times. Now, we're going to be looking this morning at the various methods used to value businesses, with a particular concentration on the value of private companies. And these have always been problematic. And we need to go not much further than what Mr. Justice Moore says in H&H. It's not the most auspicious start for poor Andrew. In my experience, valuations of shares in private companies are among the most fragile valuations which can be obtained. And as you all know, at this time, company valuations are arguably more fragile than ever. We look, for instance, at Microsoft, which has just announced it looks to return some $10 billion to its shareholders. Apple have just reported another record-breaking quarter, where they had revenues of $111 billion in their Q1. But in November, EasyJet announced its worst results in its 25-year history. And last Tuesday, I settled a long-running case where the family income was historically $12 million, $12 million per annum, derived from a multinational company doing ports and railway developments in Gulf states. But all that had dried up, but not because of the pandemic, because of fall in the price of oil and the petrodollar. Now, of course, these big multinational companies are not the sort of companies that we deal with on a day-by-day basis. But the variable fortunes of these big companies shows a graphic illustration of the volatility that exists at the moment. And we'll hear, especially from Andrew, about how that is going to impact upon the small and medium companies. Some have done well and some have done really, really badly. Now, many of you, I anticipate, will have attended the Resolution West Midlands talk with Nicholas Allen, QC, Jonathan Nosworthy and Andrew Day last Thursday. There are a number of questions as to how the pandemic is affecting business valuations, particularly in the context of barter applications. On the back of that, Andrew and I have tweaked the talk that we were planning to give. And we're going to try and deal with those questions that were left hanging last week. So that means the good news for you is we're probably not going to get to our intended topics of some tax changes and some of the later slides in today. We've left the information in the slides, so they're there for you to read and look at. And if we go ahead of schedule, we'll certainly get to those topics. But one of the questions that ran from last Thursday's talk was whether there have been any pandemic barter cases or whether any in the pipeline. And none of that panel were aware of that, and neither am I. However, there's been one pandemic case dealing with business valuations and volatilities, and that is G&T. It's G&T 2021 1FLR. It's the latest set of family law reports. For those of you who attended our October brunch, will remember that I dealt with G&T just after it came out. And just to help you, because it fits in with today's topics, we're going to send the briefing note in relation to G&T along with the notes on this. But on with our talk. And we're really going to be starting with the COVID-19 and the valuations, how the law might respond. We'll try and deal a bit with Brexit as well. And also, we're really going to start with maybe some of the questions we've had in advance. The first one is from Martin Stacey from Stacey and Mason, who really asks, so bearing in mind the current COVID crisis, when will the valuation of a business be reliably accurate? And Stephanie Colthorpe-Owen from Morrison's asks a similar question, which is, how are you going about valuations for companies impacted by the pandemic? And she points out, for example, we act for owners of haulage companies, restaurants, nightclubs in London, amusement alleys, bowling alleys, all of whom have seen their profits massively impacted. And indeed, some have been unable to operate since last March. Presumably, future uncertainties are reviewed on each case. But is there any prevailing approach developing to account for these uncertainties and in any of these areas? So, Andrew, I suppose the first question for you to deal with really is what is normal?
Michael, thank you, and thank you for your kind words earlier. I think stepping back before I answer normal is, how do you value a company? Now, the starting point, you gave us details of listed companies. The purest way to value a company is to market it and ask somebody in the real world how much they'd pay for it, and see if that is how much the person willing to sell it will sell it for. And then you can get a bargain together. I mean, that is purely what you see in the stock market. And that's why we'll always look at the stock market to see what prices are being achieved for businesses. But the sort of businesses that we generally deal with never go to market. Or if they do, they've been prepared to go to market. And which is why we always ask the question, have you had any offers for the business? Because that helps guide us to what the real world thinks about a business. But stepping back for that and taking the mind of the comments in H&H, what are we trying to do? We're trying to establish what level of profits a business will achieve under normal circumstances. What is normal? Normal is a steady state. Normal is what was happening 12 months ago for most businesses. They were on a track. They'd had no shocks in the system. They were trading on their own trading history. What we now trying to understand is what has happened to those companies since the pandemic appeared just over 12 months ago, and what are the long-term consequences of that? Because as we started talking about very early on, we're both looking at the normal and the new normal. And I recall my first cross-examination in lockdown very much focused on normal and new normal, and how well we could guess that. Because let's be honest, in the absence of really good data, and we'll come across to talk about that later, a lot of our work is intuitive and based on experience. So there's two areas we do need to look at, and if you want to move the slide on, Michael.
Absolutely. So I think we'll step to your chart. I think this is more useful, isn't it?
Well, this is about multiples. And that is one thing we learned about. There's two areas we look at. One is what is normal profits, and secondly, there is the multiple. Multiples are what the market is telling us that the business will pay, that the world will pay for an income stream of profits. Generally, we look backwards because we're looking at real world data. And of course, there is always a lag in getting real world data. But what we can learn is what happened in the last recession, which is what that graph is telling us. And we only really need to look at the front section of that graph, because what I can see is that in the immediate aftershock of the great financial crisis of 08 to 10, prices dropped by about a third. So we went, if you look at that blue line, we went from about 7.5. We bottomed out at about 4.5 to 5. But then we recovered. So by the time we get to the end of 2 years, multiples were somewhere back to where they were beforehand. And we can see, if you just trace that graph through 11 to 19, it's a pretty solid, steady state. So our initial expectation was that there would be round about a 25 to 30% drop in income multiples once the pandemic hit. And that is what I was certainly factoring into my valuations early on. And what is that about? That's about buyers putting a discount in for risk. They're looking at the earnings they're buying and going, I think there is a greater risk the business will not achieve those earnings, therefore I'm less willing to pay for them. And sellers realizing there is risk and accepting that. What we then see as we come out is new normal reappearing. So the businesses come out of their recession, we get some sort of insight to what their earnings and their normal maintainable earnings are, and multiples return back to where they were. That's what we can see then. In that case, it was about a 2-year period. So what we were expecting when we started in April, May, June last year is a 25 to 30% drop in earnings till we knew what the new normal of earnings were. And of course, when we started then, we weren't expecting lockdown 2, lockdown 3. And at the moment, I'm assuming that there is going to be no let up in this lockdown until at least the second quarter of this year. And for certain businesses, more likely quarter 3. So that's going to be pretty important when we're looking at businesses as a whole. So do you want to go to the next slide, Michael?
Yes. Now, what does this tell us, Andrew?
This was the first data we have out. This comes from a source that we use called Mark to Market, which was telling us very early on what was happening to prices in businesses. And these are for businesses where the price of the business was in the 2.5 to 10 million range, which is quite indicative of the sort of businesses that will be seen in a lot of the divorce cases where it's worth having specialist financial counselling. And what we can see is that whereas multiples were 9 in 2017 and had stabilised around the 8, 7.5 area up to the end of 2020, they immediately dropped to 5.7 in quarter 2 of this year. Of last year, sorry, it's last year now, isn't it?
Yes.
So we were seeing that 25, 30% drop we expected. So when we saw this, this gave us some comfort that the market was reacting in a way that we'd seen in the last recession. So although, as we're always told, past performance is not indicative of the future, we were starting getting some market data that told us that we were getting the sort of response we expected. But there were some interesting things coming out, which the next slide shows. And this is a story we're still seeing. This was when people drilled into the data, what we were seeing is that bigger companies were performing largely as they had been before. And that's the blue line compared to the purple line. Ignoring large capitalizations, which is very dependent on stock market activity, if we look at businesses between 2.5 million to 250 million, prices paid were not a million miles away in the period between 2019 and the first half of 2020.
So, Andrew, just for those of us who are not as familiar with this graph as you are, I mean, at the bottom, we've got the small companies here and larger ones at this bit,
yes,
at this point here. And then we've got the percentage. Now, what's this percentage scale on the left-hand side? What's that telling us?
That is what he's telling us. That's really telling us about prices, Michael. Mm-hmm. And the important one is you can move along to the next index point,
Yep.
is the price of small companies was really falling compared with the market.
Right.
So although we got a drop in prices of 35%, sorry, although we got small companies were valued at a 35% discount to the market.
And this is between 2019 and 2020, isn't it?
This is 2019. They had now fallen 50% discount to the market.
Yes.
So the smaller companies, less safe, more risky, were achieving lower prices. But as the quality of the companies and the quality of earnings grew, prices were very similar to the previous years. And what this suggested to us was that good companies will always be good companies, and those companies that were achieving good, solid earnings are still achieving good prices. So there are companies out there that are unaffected by what's happened. And the next slide starts to show, this was the latest data till this morning when I received the January update on this.
Right.
But what we can see is the shock of COVID. March 2020 was a large amount of deals were being done because it was anticipated there'd be changes to entrepreneurs relief. So there were an awful lot of deals being done in that period, really to cash out and protect entrepreneurs relief, which, as most people know when it's on the slides, the Chancellor reduced the amount available at 10% from 10 million to 1 million. And, you know, people wisely got in. But then we can see volumes dropping. So April and May were relatively low months. But there is a recovery. And we can see numbers going on to the end of the year. And by the time we get to November, we're looking at 360. December was over 400 reported deals.
So back to the March 20 figures.
Back and above the March 20 figures. What is that telling us? And the commentary, which I've read this morning, is that there's money in the market, there's money to invest. And people want to lend money, people want to invest. And if it's worth investing in good companies, they will invest in good companies. Weak companies, there is no market for, and prices are inevitably low, but good companies are still worth investing in. So it's very much back to, as we're going to talk about more, this is about horses for courses.
Yes.
And
now dealing with the various courses, this is very much Stephanie's question, but here we have, you know, how are the different sectors being affected in your experience?
Well, I've looked at, in fact, over the last year, I have had to do valuations on all of these three business sectors. Actually, that's not quite true. I've not had to do the wedding venue one because they still haven't sent me the information, but I know it's been shut since March, and they were preparing forecasts assuming they would reopen this March. And I suspect, again, they're probably now looking again at next June as possibly the earliest time they're going to reopen. That's absolutely critical. These businesses have generally had no income and very nominal support from the government. Therefore, they are losing money and hemorrhaging cash. The first question we've got to ask ourselves and it's not on that slide, is, can they restart? Is there still a business there? And it's going to depend very much on individual decisions by the business owners. But certainly a public house group we issued a report on yesterday, they have shut some of their venues and they will never reopen them. Some of them, though, will reopen. So it's a case of looking again at the individual components. The event organizer I looked at, they had literally made every member of staff redundant. and had reduced that to literally an owner managed run business. But that was a business that historically had made a very good profits. So the questions we're trying to assess is, first, can the businesses continue to trade? What will they look like when they restart? And again, we don't know, but whether it's beginning to get a feel for what we're going to start looking like. And certainly some of the market data I'm aware of is suggesting that in truth, 2021 is going to be a very weak year for this segments, these market sectors, but they will start to recover. And really, it's only when we're the second cycle of vaccinations that we're going to start looking at these businesses being able to trade relatively freely.
And of course, I mean, events organisers are generally service businesses, so their overheads are going to be relatively low. Whereas something like a wedding venue and public houses, of course, have physical bricks and mortar infrastructure to maintain.
Absolutely, and they're losing
how
money.
How does that impact on the risk between the two? Mm.
Well, the important bit from our point of view is we have to factor in the amount of debt they're going to accrue. Because even if they are still good businesses able to trade on the basis of good, solid financial earnings, we have an issue because they are now laden with debt. And therefore, their valuations will inevitably reduce. Interestingly enough, I was looking and issued a report this week, and I don't think the solicitors are in the audience today, on a business that was a startup 2 years ago and had just started to come to profitability at the start of lockdown. So it's never made a profit. But it's got investors, the banker supporting. There's clearly a good business in there. But at the moment, it's worth absolutely nothing because it's got negative net assets, it's got no profits. And therefore, on any normal basis, you can't see a value in it. But there is a value in it because people are still investing in it. And therefore, we're starting to look at things like hope values. But the downside of that is when we're going to talk more about liquidity later on, they have no profits and no cash available to them. And at the moment, they're building debt up. So it's going to be a long time before those businesses have a real value in the marketplace.
And as a forensic accountant, how do you value hope value?
Essentially, I look at what I think the profits are going to be in the future and then assess that in the basis of, what that would be worth at a point in time. In that case, we've created some forecasts, we've looked at some business plans, looked at the sort of level of profits that business is expecting to generate, put a normal multiple on without some of the risk in it, because it's a hope value, but then taken off all of the debt. And even allowing for that, that business only had a very modest value because of the debt. However, once it generates profits and starts paying off that debt, that will hopefully rise very quickly and the value will move very quickly in the medium term. But we're talking 2 to 5 years before there's any value in that business for that reason. So it's a case of looking at forecasts, Michael, and trying to understand what you think it will be worth in future. And of course, this is almost the Dragon's Den thing, where they go in and say, my business is worth this. But that's purely because they've gone, well, if this happens and this happens and this happens, then it should be worth that in the future. A bit more scientific than that, but it's very dependent on us seeing underlying numbers, such as business plans, up-to-date accounts, bank statements, and forecasts, so we can get a feel of what's there. And generally, with very small businesses, we have no forecasts, quite often no management accounts. So we're left feeling, and one of the things we've had to resort to is looking at what businesses were trading at before the pandemic started, and then assuming they're going to return to that in the absence of any other evidence.
And then also how they can deal with the debt they built up in the interim.
And then they'll have to deal with the debt in the interim, very much so.
So I mean, let's take a look at some businesses that have done well in your experience. So those were the bad ones, and these are the good ones.
Yeah, very much so. I've not put construction on here. Construction, apart from a very short lockdown, bounced back very quickly. So anything construction sector and government funded, generally, in those sort of infrastructure areas, seems to have done pretty well in the lockdown period because they've been kept trading. If you all remember back what it was like in March, April last year, the sun shone. We couldn't go anywhere. So there was an absolute demand for garden furniture, for DIY products, caravans and mobile homes, because people realizing they weren't going to go anywhere abroad very soon. And so these businesses actually did very, very well under lockdown. However, there are some issues we need to address with those issues.
Well, I think you and I were talking about also, I think for the smokers amongst us, you had a tobacconist that had done rather well, hadn't it?
That's the next slide. So we'll look at
right, we'll look at that one. Right. So I apologize. I'm jumping ahead of myself. So moving on to this one.
But if we can we go back to the other slide, Michael?
Yes.
Because it's worth thinking about that garden furniture business. That started the year off with ready for the summer season. What happened in the early part of this year, it had huge demand and virtually sold every item of stock it had. That would make it a very liquid company, but actually unable to trade. And one of the problems we're seeing with a business such as that at the moment, and in fact, and the caravans, they couldn't supply the demand at a certain point. They started losing sales and they can't replenish that stock. The garden furniture business was buying from China and Vietnam. So they were dependent on those economies restarting, and then they were dependent on the availability of container ships and the price of container ships bringing goods into the UK ports. We now know that the UK ports have got jammed up because of the sheer amount of stuff moving. And I've just seen Martin Stacey's just said, bike shops are another example. No future stock. Again, very similar product. If we're importing goods for resale, we are just, there is just an awful lot of people that cannot meet demand because there isn't any stock. So it may be another 12 or 13 months. So it may be this business may have done really well last year, but actually we might have a different view and we may be looking at 2 or 3 years to recovery. And don't be fooled by if they look very liquid at the moment, because those businesses have effectively liquidated their working capital. And one of the issues we're starting to have to look at, and a group of us are about to go and have a chat to try and work out how we approach this, we need to look at what the normal working capital is in a business, because businesses at the moment have an artificial amount of cash if they've liquidated their stock. So it's something we have to be mindful of. And I'm sure those representing the typical wife are going, yes, there's cash to pay me out. Whereas the typical husband is going to be saying, but I need the business. And I need the money to be able to restock my business to carry on trading. So questions we're going to have to look at, and it's almost on a time-by-time basis. But let's look at our tobacconist, Michael, because I think it's really interesting.
I like this one.
This is a business that the husband was telling us was probably actually not worth a huge amount of money. And in truth, a tobacconist in the current market probably has a very limited lifespan and there's very little goodwill in them. But what we saw with this business is it had a very good online presence. And so a business that was turning over online in the early part of the year around about £100,000 a month suddenly went to £450,000 a month. And therefore, are we valuing a tobacconist in a classic bricks and mortar shop, which has very little demand, very weak multiples, or are we looking at an online business which would attract a very much higher multiple? And where on earth does this go in the future? Because of course, the last figures I had were May before we came out of lockdown, and this report was released in the middle of the year. Where is that business going? We talked to the owner about how much of his online business he thought he would keep. But this went from a business he was expecting to keep round about 300,000 a month of business online. So what was going in as a business turning £150,000 a month, circa 2 million, suddenly becomes a business turning over 300 to 400,000 when it reopens and it retains its online presence. So you're looking at a business then turns over 5 million, lots of it online, and therefore a much more valuable business in multiplier terms. So I suspect he cried when he got the valuation that was looking at a much higher multiple than he's expected, as well as higher earnings. But he looked like he was going to be a winner in this out of the pandemic.
Well, I suppose on the face of it, you would have thought a retailer and a shop would have been worth virtually nothing when the whole thing began.
And absolutely, if you look, he's making no sales in May on the orange bar.
Yes.
Look at that big blue block.
Yep.
So, that is, I suspect he's probably one of the few tobacconist businesses that's done well out of lockdown. The rest are in survival mode. He's flourishing because of this. And his biggest issue was how much money he had to buy to increase his stock levels to cope with the new demand. Because suddenly he was selling 3 times as much and therefore is likely to need 3 times as much stock. So,
and what's your multiplier that you're looking for on an online business like that as opposed to a shop business?
It varies, but I think we were relatively generous and cautious. I think we went from something like 3 to 8. Mm-hmm. But online businesses can be utterly stratospheric because the market will put high multiples on them because they believe there's going to be growth in them.
Yeah. So just to recap dependent on. Sorry, Andrew.
Those things are very much dependent on the market.
Yeah, but you're looking at a multiplier of 3 if it was just a shop retail business, and then 8 or stratospheric if it's mainly an online business.
Yes. Yeah. And so it's a very big judgment call. And as we started, a lot of these things, these are judgment calls because these businesses are not for sale and never have been for sale. And therefore, we being asked to undertake a hypothetical answer to provide them to guide the court, using our experience and our knowledge and talking to our contacts to get some idea of where these things should go.
So I think we're going to move on to government support and how that might affect what we're doing and liquidity issues. So what does this slide tell us, Andrew?
Okay, I think it was just worth us looking back at what was in the marketplace and what was available, and some of it still is available, and how businesses are surviving. Because what we've got at the moment is businesses being provided with a mixture of grants and funding and debt. And as time has gone on, it's the debt that's going to be more important to us. Furlough and the grants or the rate support are merely just trying to get these businesses to the point they can reopen, and hopefully they won't have been damaged. Certainly, I've seen various businesses that have just mothballed, and they're neither making profits or losses, and we'll have to see what happens when we get to the other side. But other businesses are dealing with significant debt, and that's going to be really important. One of the things we've had to be mindful of is that one of the first things that was announced in March last year was the deferral of VAT and PAYE liabilities for 12 months. They're coming due at the end of March, and unless the Chancellor says something in the next budget, we're looking where there's a situation where businesses have got some more debt that wouldn't normally be debt in them. So we're having to look, when we're doing valuations and assessing what debt's in a business, slightly wider than looking at the usual bank debt, because there is actually almost now structural debt in the form of VAT, PAYE, and probably more directors' loans as they've been propped up to get to the point of reopening. One of the things that we did talk about early on also was how we could use C-bills loans. The government have been were relatively light on what they were advising money could be used for at the time of the first lockdown. Since C-bills 2 has come out, we're starting to see some enforcement. And if you go to the next slide, Michael, I think it's quite important. The loans are being restricted in their usage, because some of the very early C-bills loans and bank-backed loans were used for all manner of less relevant things. And we're starting to see the first legal actions in relation to the use of C-bills and bounce backs. There's no doubt there was an awful lot of fraud in there. And I had to warn at least one client, no, it is not a good idea to buy a Maserati with your C-bills loan. Yeah. But inevitably people will have done it. That isn't the spirit of it, and the government have now made it not within the terms of it. And we've now seen the first cases where HMRC have gone in and frozen bank accounts where they think the C-bills loan has been not used properly. Now, I'm not saying we're likely to see that in the sort of cases we're dealing with, but I think we can conclude from this that we can't be using a C-bills loan to buy back shares, which is, of course, one of the routes we would be looking for when assessing liquidity in a family matter. Equally, I think it would stop us where we are in receipt of a C-bills loan using those funds to be able to do a share buyback. So the usual ability for the business to provide the funds to enable a buyback and the paying out of the second party, I suspect is not going to be there. So there's going to be a serious restriction on liquidity in businesses for a foreseeable time. So it's something we've got to be really minded of.
And Andrew, there's a flip side. I've had a couple of businesses come across my desk which were doing pretty well, and they're well run, and the owners have been looking to the C-bills loans and the bounce back loans, etc., really just to build up extra liquidity so they can expand and move forward. And one of the examples, I suppose, the supermarkets that had their relief on business rates. Now they paid that back, but of course that would have flattered their bottom line hugely. So there's a lot of benefit out there that people are taking advantage of that they don't really need, and it's actually going to enhance the value of their company, is it not?
Absolutely. I mean, a couple of years ago, I valued a funeral directors, and I'm still in contact with them. They did very well out of lockdown, as you can imagine, but they got rate relief on all of their shops. Yes. Because they're a retail operation, so they got a windfall on all of their shops, and no doubt got another one this year when the latest batch of rate relief was announced, even though they're having their most profitable year ever. So it's an interesting set of problems. But from our point of view, there is no doubt some businesses are going to use the business to enhance their business, provide additional working capital because it is relatively cheap. But they're probably then looking to pay back down those loans relatively quickly or replace them with more normal commercial lending, so they can get on and run their business and generate profits and take money out as they always have. But it's worth being mindful of, from the point of view of the practitioners in the room, what was needed for a CBILS loan. So, and the next slide we'll talk about that, Michael.
Yes.
These are loans. When businesses apply for loans, banks will normally ask for management accounts, up-to-date financials, cash flow forecasts, business plans, and details of assets to give security on. You can assume that everybody who has gone for a CBILS loan will have had to do something like that. So all those businesses that say, we don't do management accounts, we don't do forecasts, we don't do business plans, if they've gone for a CBILS loan or any other lending in this period, they will have had to do it because banks are trying to assess the values of their security and the long-term ability of the businesses to pay back these loans. Because although they're government-backed, they've still got to be repaid. So that information should be out there and be available to everybody.
And of course, very important when you're looking at whether you're going to make a Part 25 application to get a single joint expert in, or maybe just take a look at the cash flow forecasts to see if you can come up with your own working view on it as well.
Absolutely. This is the sort of information that's invaluable to us. I mean, we have to make lots of assumptions if the information isn't there. The better the information we get, the better the valuation we can come up with. It'll never be 100% accurate because we're not testing the market. But what we can see is indications, we can see trends, and we can form better conclusions to inform the parties and the court of what's really going on here.
Now, we talk about the pandemic a lot. I think we're going to move on to Brexit, are we not? And those sorts of issues.
Yeah, Brexit. The issues we've seen with Brexit, I suspect, are very similar in truth to the issues we're seeing with COVID. What we don't know, it's very early days with Brexit. We're seeing short-term impacts. We know we've got the problems at the ports that were very similar to those that were happening pre-Brexit anyway, because of the way that the container ports were being jammed up. But we are seeing problems with small-scale businesses that import and export to the EU. So, you will have probably seen, if anybody reads the Daily Mail, it started picking up items that the BBC started running about people being asked to pay VAT, customs duties, and delivery charges on receiving goods from the EU. Equally, there's been confusion as to what businesses have to do in the UK if they're selling online to Europe. So there is some problems there. There is red tape. There is costs. And we haven't quite seen them fully develop. Although hopefully we probably aren't doing much business in Northern Ireland, I know Northern Ireland is a particular problem at the moment because goods are not moving well in Northern Ireland. So we were talking to somebody who was saying the contrast between the supermarkets in England and the supermarkets in Northern Ireland is massive. Apparently, we can buy broccoli. Northern Ireland can't. The stuff isn't getting into there.
I think my children may want to move to Northern Ireland.
Yeah, I'm sure your children want to move to Northern Ireland if they never have to eat broccoli again. So it's early days. We're going to have to assess it, but we are seeing problems, and there's no doubt hauliers are probably the one area that we are going to have to try and unpick as to what's happening. It's early days, but we are seeing delays. We are seeing some evidence that trade isn't as frictionless as it was, and we're seeing evidence of increased costs. So, yeah, to watch this space, we're going to need to look quite carefully at those businesses that are really Brexit affected. We've seen a lot of allegations of things being Brexit affected over the last couple of years. Quite often, it hasn't been Brexit, it's been perceived issues. But wait and see. What I would say is that generally, I don't need to look at maintainable earnings to look at the effect of Brexit. Market prices have already generally discounted the effects of Brexit in market multiples. So there is already some Brexit pricing when we come and do valuations.
And are those discounts significant, Andrew, or are they fairly modest?
Difficult to know. It really is difficult to know. It's the market.
Mm-hmm.
And without understanding what the whole of the market is doing, but we know that the market and share prices have been discounted quite heavily, or sorry, to some degree, since 2016, since the vote. So there is some long-term market adverse sentiment that is feeding through to multiples and how it's done for a while. So
now we're going to move on briefly, I think, to how the law may respond to some of these issues. I'm going to take this fairly shortly because I have an eye on the clock. We've very much been concentrating on the sort of the pandemic issues, how that affects it, and sort of for the lawyers amongst us, there's some useful cases here. I mean, Cornick and Cornick, it's been old, 1994. But of course, that was simply dealing, this has been the context of barter type events. Something unforeseen and unforeseeable had happened since the date of the hearing, which has altered the value of the assets so dramatically, so as to bring about a substantial change in the balance of assets brought about by the order. Then, provided the other three conditions are fulfilled, the barter principle may apply. However, in the circumstances can happen are very few and far between, and the case law taken as a whole does not suggest that the natural process of price fluctuation, whether in houses, shares, or other property, and however dramatic, fall within this principle. And that's Miss Justice Hale, as she was. Now, that was perhaps the opening of the crack of the door, but it was shut pretty firmly in Meissen and Meissen, and those will recall that was a city boy who his wife took most of the hard assets. He took the shares, and they collapsed absolutely hugely. He wasn't even able to meet the lump sum orders. He tried to vary and was told, well, no, assets fall. And it's interesting to see, well, we're seeing an interest, a similar drop in turnovers and multipliers that we saw in the previous recession. And we know from Meissen that that is not good enough for a barter event. And one wonders, it's hard to foresee a pandemic, but then the impact on share prices and your multipliers that you showed us earlier, Andrew, seems to suggest that actually it's pretty similar to the previous recession, which would give us trouble at law on that. Now, just moving on, and for those of you who look at the briefing notes on G&T, there's an expanded section on this. But Andrew, this comes with your point about what is normal and how the courts deal with it. And these are different cases. They don't all deal with a pandemic or a financial crash. But if we look to what happened in Wells and Wells, the wife was allocated shares by the Court of Appeal so that she would get a cut when husband sold his music business, which at the time of the trial, Andrew, like a lot of the companies you mentioned, were making a loss, a bit like your internet, your startup company. Joy Marancino, the Weiss Capital claims were just adjourned. Quentin Bray, there was an adjournment again. AW and AH is a slightly different case. Really, and AW and AH and Haskell are dealing partly where you just can't be sure of the valuation because in both cases, husband was playing fast and loose with disclosure. AW and AH, there was a 7-year adjournment of Weiss Capital claims to allow for husband really, the thought was really that the monies that husband had stashed away would probably come back to him, and you could take a look at it after 7 years. Haskell and Haskell was Mr. Justice Mostyn, who is pretty keen on a clean break. And so what he did in that case, well, this is a husband who said because of debts, he was hugely, I think about 50,000 in the 50 million, I apologize, in the red. But Mostyn said, look, I take a view that his fortunes are going to recover. And I think they're going to recover in the next couple of years. So I'm going to give him a 2-year breathing period in which to provide a capital sum to wife. So he fixed the capital sum. But interestingly, Haskell and Haskell was a needs-based case, not a sharing-based case. So I think, Andrew, it makes matters easier that you can sort of stick a finger in the air, look at needs, look at is it probably affordable, and make a decision. Finally, we've got G&T that I mentioned earlier, and it's a big case, and it's worth going through and just take a look at the briefing notes, because very much it's Nicholas Cusworth QC did the judgment in about April, and of course the pandemic hadn't really dug in, but certainly he deals with a hugely volatile company whose valuations changed by I think 7 or 12 million in a very short period of time. Between run up to the trial and the trial, and also had a slightly uncertain future that he couldn't be sure about. And very much on that, he stepped back and chose what he thought was an appropriate point in time to do the valuation, and looked at the value, I think 9 or 12 months prior to trial, which was considerably higher, because he thought it was a fairer measure. And I think it's very important when we're dealing with these cases that Andrew and his team will come up with the numbers and the projections of the future, but there is a very wide judicial discretion as to how you interpret those numbers and how you apply them. So that's really where we're going with that. Now, Andrew, and we were going to move on to that, to looking at springboards, straight line, and looking at reality of passive economic growth. Now, bearing in mind that we have about 8 minutes left, what I propose to do is we'll leave those slides for other people and really deal with the questions that are running. Now, I think
very much so. Yeah, agreed, Mike.
So, the first question is really, can you assist us with anything with how the film industry are doing at the moment?
I've not seen the film industry yet, but we know, from just reading. I mean, the important part of what we're doing at the moment is trying to see what's happening in various sectors. And as one comes across my desk, we go and do some more research. But I can imagine the film sector is in a real problem at the moment because of production and distribution issues. So, yeah, I can't comment directly because I've not seen it. But I imagine they're going to be yet another business that is going to be in a slightly distressed state and trying to understand what it looks like in the near future.
Now here's an interesting one, the next one. February 2020, an agreement based on a family-run company doing garden rooms. Multiplier was initially 4, but was significantly reduced to multiplier around about 2 with discounts, etc. Agreed as a settlement, but no consent order is due to other issues. So we've got an interesting issue. I mean, I will deal it from the what you can do legally in relation to this. But in terms of the valuation, any comments on that? I mean, from an amateur viewpoint, that seems to be a very low multiplier indeed for a company that's probably done pretty well.
Yeah, 2 is a very low multiplier for a business that we now know will have done very well, because people generally, it's back to the point of our garden furniture and our caravans, you could not get garden rooms and small extensions on properties, and people wanted them because they realized they were going to enjoy their houses more. So yeah, that's a business that should have done very well, though what the long-term prognosis is interesting. So it may be that business comes down to a nice steady state in due course, but it may have a lot of extra liquidity as a result of what's happened. So
I suppose arguing against it, I suppose you might turn around and say, well, February 2020, that was normal trading conditions pre-pandemic, and it's going to settle down, in 2 or 3 years' time. So maybe it's a glorious blip, but no more than that.
Absolutely, and that's where we are. But what we should see is a leap in liquidity.
Yep.
There should be a lot more cash in the business to arrange a settlement.
And interestingly, I mean, procedurally is interesting because you don't have a consent order at the moment, and no judge has approved it as yet. So you've got more scope to play around than it being a strict barter event. If it was a strict barter event, I'd probably be pretty pessimistic on that. But you've still got to run it past a judge. And let's remember that the settlement has to be approved as at the date of the hearing, not as the date of the agreement. So you might have a bit more scope to play around in relation to that. So there's that. Also, there's been some more recent cases. There was Mrs. Justice Roberts, I think, in Z and Z, who was expanding the scope of the barrel jurisdiction. That was post a final order. But what she did in relation to that was totally reworked an order because the financial arrangements had changed hugely on the ground. And so if Mrs. Justice Roberts can do that in Z and Z, I think it's Zimama and Zimama, I think was the other wording of it. You might have a bit more scope to play around, particularly as it's pre-approval by a judge. And certainly, you know, I have gone to court before now where you've got an absolutely stitched up Zidius agreement, and you just turn around to the judge and go, absolutely, arrived at, full advice, etc., etc. But I tell you, it is not fair, and this is why. And the judge will go with you on that because they are exercising their discretion afresh to determine what is fair.
And remember, in that case, if you're looking at a February 20 consent order, we've got 12 months more. There'll be at least 1 year's more accounts available.
Indeed, but the point is, it's not a consent order. That's the Zidius agreement.
Yeah,
the court hasn't approved it yet. So you may get a get out of jail free card. If need be, pick up the phone and we can have a chat about it this afternoon. Now, okay. Andrew, that takes us rather nicely to...
Well, there's one more question we haven't answered, Michael. I'll do very quickly, and that's from Victoria Myerson.
Oh, yes.
Asked, what is your view regarding the impact of the pandemic on the value of commercial property owning companies and the downside of foregoing a company valuation and instead relying upon property valuations alone? Very simply, whenever we're dealing with property companies, we need both property valuations and company valuations. Because, of course, the property valuations deal with the bricks and mortar and quite often the trade within it. So pubs, hotels, care homes, they will need to be professionally valued as bricks and mortars and possibly bricks and mortars with the relevant goodwill attaching. But you'll still need the accountant to put them into the relevant corporate shell to make sure you're dealing with all the adjustments required for debt and any other assets that are lying around, or possibly any alternative trades, because there may be more than one trade in the business. But normally, there should be a relatively modest cost for doing a net assets valuation once the main commercial property valuations have been done. And I don't think the pandemic makes any difference to that point. All I'll say is the property valuers have got exactly the same problem that we have.
Right. Anyway, so that takes us to our hour, bang on the nail. The bad news for everybody is that I'm going to be back doing our next brunch. I'll be here with Oliver Thorne, and I'll be dealing with maintenance pending suits and the most recent authorities on that. I think Oliver's going to be dealing rather appropriately, bearing in mind our second last question, with applications for notice to show cause on the back of Zidius agreements. So Delphine, I've forgotten the date of that. Perhaps you could pop it up on screen so I can remind everybody. I think Delphine has got, I think
25th. It will be on the 25th of February, Michael.
There we go. So 25th of February, hopefully we'll see you there. Andrew is very welcome to join us, though I'm not sure how relevant it'll be to his practice. But can I say a particular thank you to Andrew for giving up his time, because it's not often that you get to sort of pick the brains and also look under the hood of these valuations. So thank you very much for Andrew, and thank you very much to everybody for attending. Thank you.
Thank you all.